The Bank of Canada lowered its key interest rate by a quarter point earlier this month, which was welcome news for many Canadians. However, while that trend is certainly welcome, there are several economists who have said that it will take some time for the rate cut to have any sort of impact on the Canadian economy. But that impact, when it does take hold, could be significant given the role that the BOC's rate plays in all aspects of the economy. Joining us now to discuss how lower interest rates will impact investing in Canada is Brendan Caldwell, Director at Caldwell Securities Ltd. Brendan, thank you for joining us.
Always great to be here, Theresa.
Now, will lower interest rates in Canada impact trading, and if so, how?
Yes, I mean trading in stocks, you mean. I think it'll impact a lot of different areas if we, in fact, are getting lower interest rates. I think the Bank of Canada might have been titch optimistic in cutting rates at this stage, or another way of looking at it is they might be a bit pessimistic about the Canadian economy. Certainly, we haven't been as robust, as strong as the United States, who I don't think are going to cut interest rates anytime particularly soon. But yes, lower interest rates should, in the theory, help the stock market because it's less expensive to borrow. Margin accounts, that is accounts where people are borrowing money to invest, are less expensive. Probably help the housing market as well. Whether that's a good thing or not, I do not know. Up until this point, I would have told someone who's looking to take a mortgage out to get a fixed rate mortgage. I'm sort of on the fence at the moment. I think fixed rates might even be lower than floating rate mortgages at this moment in time, but there is a chance that those floating rates could actually come down over the next 6 months or a year.
And how do changing interest rates affect trading risk and strategies?
Oh, well, if your cost of borrowing is greater, then you got your marginal return, the amount of money you're going to have to make on a particular trade is going to need to be greater. So the higher the interest rate, the more unlikely it is people will initiate what could be considered marginal strategies if you have to make a bigger cost of capital. So during the whole period, really up to the beginning of 2022, when interest rates were really throwing a few more reallys low, you had a almost no cost of capital, which meant trading volumes were considerably higher, particularly in Canada, which is a marginal market at best on the global stage. Trading volumes in Canada were quite a bit higher when interest rates were lower. So lower rates do affect the volume of trading, particularly on the margins. And as we're on the margins of the United States and the Arctic both, it makes a big difference to Canada.
Do you foresee interest rates and, in turn, inflation rates influencing market volatility?
Yeah, well, it's more the anticipation of rates. When interest rates looked like they were going to go up forever, that was a bit of a downer on the market. But then last autumn, there was talk, misguided, as I think I've said on this show, misguided, that the U.S. Federal Reserve, which is their equivalent of the Bank of Canada, would start cutting rates in the States. There is realistically no possibility of that this summer in the United States, maybe in September, but then do they want to get in the position of seeming to affect the U.S. election when, as you said in the introduction, any change to the lending rate and what the central banks actually change is the lending rate to commercial banks, which then lend out to real people, consumers, businesses, what have you. Do you really want to be in the business of being seen to trying to affect the U.S. election by cutting rates 6 or 8 weeks before Americans go to the polls? So I don't think the U.S. Federal Reserve is cutting rates anytime soon. And I think the U.S. market is beginning to accept that and still seems to be fairly robust anyway, which is odd and really unusual, because if you thought that rates were going to lower rates were going to cause the markets to go up, that they're still going up anyway is a curious situation.
And what are the implications of differential interest rates amongst countries for international trading?
Yeah, it means that our current Prime Minister, who's named Trudeau, could surpass his father in getting the Canadian dollar to its lowest possible amount ever. I think on a show, maybe this one in the last while, I'd said, I can see the Canadian dollar at 60 cents. If the U.S. keeps its rates consistent and the Bank of Canada cuts rates, that and weaker oil prices could get our Canadian dollar down to record lows, even lower than it is now or it has been.
Brendan, thank you so much.
Thank you, Theresa.